Hi, everyone. I'm here to quickly go through our EIU Global Outlook, take you through some of the trends that we are seeing, look at the global economy, and then after that, we'll have all the heads of research from Maybank to come up as well and go through their own countries, do a bit of deep dive, and we'll have them on stage to ask questions. Before I start, I'll tell you a little parable about a taxi driver. So, as we were coming out of COVID, I was very excited to start traveling again, and I was getting in a taxi to go to KL. I go to KL quite often, and I got in a taxi. The taxi driver asked me, "What do you do?" So I said, "Oh, I work for the Economist. I go around, I talk to clients, I tell them about the political outlook and the economic outlook and the business environment." I was very pleased with myself, right? I was like, "Oh, this is good conversation with a taxi driver." And he turned around and he told me, "Oh, you guys, you get things wrong all the time. You tell me that China is going to crash, it's doing very well. You tell me that housing prices are going down, it's so expensive. You tell me inflation is not happening in Singapore. I can't even get my chicken from the market. They're all in Malaysia. What's happening?" All I can say is that I was very glad that I didn't live too far away from the airport, because that was an uneasy taxi ride. And so I ask you all to channel your inner taxi driver, look at my presentation, get your questions up on Slido, and we can have a good session of questions at the end. So this is what I'll take you through. These are the 5 things that our analysts are thinking about right now that are driving most of our forecasts. So I'll spend a bit of time on this slide. The first one is that the global economy is a bit more resilient than we thought it would be, and there are a couple of reasons for that. So sitting in sort of September, October last year, we did think that around this time this year, we'd probably be in a shallow recession in Europe. We'd probably have very, very flat growth, if not a recession or soft landing in the States, but that hasn't happened, right? In EU, they realigned their energy infrastructure pretty quickly. They also had a relatively mild winter rather than wild winter, and that helped, right? So we are sitting now in Europe, it's doing a bit better. It's stagnant, so about 0.8% growth, but it's certainly not a recession. The other thing that took us by surprise is China, right? So we did think also around September, October last year that China would come out of its zero COVID around sort of the middle of this year, so around this time. But of course, it exited from its zero COVID strategy in December. It did it very quickly, and that gave the global economy a bit of a bounce, right? So I want to talk about that, what that consumer-driven rebound means for the world and the rest of Asia. But certainly that means that we are in a little bit of a better shape, nothing to really shout about, but a bit more resilience that we are seeing in the global economy. The second point is inflation. We used to be in a world for about a decade where inflation was low, interest rates were low, and of course that is no longer what we are seeing. So I'll talk about the prices of hard and soft commodities, why we think inflation will be a bit more sticky, and then what that renewed demand for China, from China means, right? There's a bit of an upside and certainly some disappointment as well in terms of the commodities. People are still spending, so as we went through COVID, there was a lot of subsidies, a lot of government handouts that put money in people's pockets. We are seeing that runway kind of evaporate, but a lot of the growth in Asia has been sort of consumer-driven, and that has uplifted our region especially. Geopolitics and protectionism, now that has been around for a long time, obviously, but the tension between the US and China and that rivalry, that geopolitics, geoeconomics is driving a lot of the differences and changes in supply chains on top of secular changes to the global macroeconomic environment. So that's also something that's driving a lot of our forecasts, so I'll touch on that. And then, as I said, the return of China, we were very excited about it. I think some of the news now points to a slightly different picture, so there's some downside risk to China as well. So these are the 5 themes, and as I go through the rest of the slides, I'll talk about these as well. But first, this is our our forecast for the global economy, right? So what you're seeing now on the screen is a map of the world. Each of the hexagons represents a country, so you can see North America on your right, East Asia, North America on your left, East Asia on your right, and the colors are essentially a heat map, right? So the lighter blue colors are slower growth of about 0 to 2%, and then the brighter colors that are in yellow or orange or red are stronger growth of about 4 to 6%. So you can see, as I mentioned, the US stagnating. In North America, a lot of that light blue color, that's the same in Europe. We are predicting about 0.8% growth there this year, so essentially stagnation. But look at the region that we are in, right? In Southeast Asia, in South Asia, you see a lot of those reds and those yellows. India, a bright spot, is it going to be a new manufacturing hotspot? Thailand, Vietnam, Malaysia, Indonesia, all growing at pretty good rates, right, compared especially to the rest of the world. One country, of course, to point out is China. You can see that China is in red. So we forecast that China will grow at around 6.1% this year. We are a bit more optimistic than the Chinese government, who think that rate will be around 5%. But that's a big change, not only for the region, but also for the world. And that's because last year China grew at around 3%, right? So it's a big bounce from last year. And a lot of that, of course, has to do with China opening up. Now, global forecasts, ours is around 2.1, 2.2%. We've revised that up a little bit as we started the year and then have come to the middle of the year. But as I said, that's resilience that we are seeing. It's not really something to shout about. In the last 20 years, global growth has been below 2% only twice. One was during the great financial crisis in 2008, and the other one was during the first year of COVID. So 2.2% is sort of just resilient, not a great story there. Now, of that 2.2%, China is going to contribute about 40% of that growth, right? So that's how important China is to the global economy. And the US and Europe this year combined will contribute about 20%. So just to give you an idea of the relative contributions of their growth. So that's the picture of our global growth story. China's pivot, I think, has been good news for most economies. It has lifted. We are seeing firmer growth in Asia because of demand there that is coming for different types of commodities. Also, of course, tourism has rebounded. That has benefited some countries like Thailand, especially. But what I have here is, the G20 and growth, and how the dark blue is 2023 and the light blue is 2024. So you can see where we are forecasting better growth this year and how we've changed our forecast, right? So the war in Ukraine, of course, still fundamental to global growth and what our outlook is. So I'll talk a little bit about that as well. And all of that supply chain disruption that we saw through COVID and because of the war in Ukraine, some of that is shifting as well. Now, the news about China, of course, as it came out of zero COVID, the bounce was very quick. The second quarter growth in China has been flat. So it's almost like a double dip there. And that's something to pay attention to. The contribution of China to growth for the rest of the year might be a bit more tepid than we initially expected. Now, this is our story on commodities, and I picked a different bunch of commodities. I could have put many different things on this chart, but you see a lot of squiggly lines. Let me tell you what those are. On the left is hard commodities, so industrial raw materials. I put metal, fibers, and rubber there. On the right is soft commodities, and that's things like grains and sugar and oil seeds. And we have the graph from 2019 on your left, so you can see pre-pandemic prices, and then forecasted out to 2024. And that black dot is sort of where we are right now, right? So you can think about where prices have come from and where they are going. Now, you can see that through COVID, there was a spike, and then, of course, because of the war in Ukraine, prices were elevated. For hard commodities, that's coming down, and you can see that they still remain elevated compared to pre-pandemic levels. For the soft commodities on your right, you can see that they've come down, of course, faster than hard commodities. That's mainly because soft commodities are things that you plant in the ground. Their harvest cycles are much faster, so you can be a bit more flexible. So prices have come down a little bit. But a couple of things that I want you to take from these slides are that the shape of these are similar, right? So the story is similar, and that prices will remain elevated going into the end of 2024. So they're not going to come down to their pre-pandemic levels just quite yet. A lot of this at the EIU is driven by our view on the war in Ukraine, and we think that that war will last for our forecast period, which is another 5 years. It won't look like how it's looked like in the last 12 months, so we expect that tensions will come down. It won't be a hard shooting war as much as it has been, but it will still remain a low-intensity conflict, and that will drive prices or maintain that price level going into 2024. And so that speaks a bit about some of the inflation story that I told you on that first slide. So this is inflation. We did mention that it will be sticky. And so I have two graphs on inflation, and one is to show you what we feel, and one is to show you what it's going to be, right? So the graph on the left is the big 6 economies in ASEAN, and it's monthly inflation. So you can see that it's still quite high. Some of them have stabilized, the Philippines, but still very high there. That Philippines is the yellow line. And the others, you can see some of those trending downwards in the monthly column. But to consumers, to people out there, cost of living is a huge issue. And what we are seeing going forward past and into 2024 is those levels of inflation coming down, right? So generally, central banks in Southeast Asia have done pretty well in terms of reacting to the Fed. Most of them reacted quite quickly, and so they've got a handle on inflation. And so we think that they will come down towards the end of 2024. So you can see from the quarterly forecast, the shape of that graph coming down a lot faster. So still sticky. Global inflation was around 9.5% last year. We forecast it to be about 7% this year and 4% next year. That's still a lot higher than it used to be pre-pandemic, right? So still pretty sticky in terms of the inflation story. This is a slide on FDI, going back into the early 2000s and then forecasted out into 2027. So you can see that gray line on top in terms of the trend overall, so increasing FDI into ASEAN. ASEAN is that blue color, dark blue color. China is the light blue color. And then India, which is quite interesting, is that yellow color. So as you can see, from about 2020 onwards, that dark blue color for ASEAN is increasing, right? So at a decent clip, but going up into 2027, you can see that we do predict a lot more FDI coming into ASEAN. India is the other story there where FDI is going into India as well. So that's the general trend that we are seeing for FDI in the region. Geopolitics, of course, is a big reason for that, but supply chains have shifted for many different reasons as well. But to give you a bit more insights into what that means, I have this chart here, which is probably my favorite chart, on who wins from the unraveling of Sino-American trade, right? So we all know about the trade disputes and the increase in the rhetoric. In 2015, China had a made-in-China policy, and that sort of kicked off this trade war. Of course, there were Trump tariffs as well during the Trump administration, and then that's transitioned to different but sort of similar-looking policies under the Biden administration. And so that has been part, industrial strategy is now sort of one of the core elements of trade policy. We haven't seen a lot of friendshoring, right? So while Mexico and Canada have increased a lot of their trade with the US, that generally hasn't happened, right? When Trump put up the tariffs, the initial thinking was that the regions that would benefit were South America and Africa. But if you look at this graph on your left here, this is exports to the United States from 2018 to 2022. Trade data takes a little bit of time to come in, of course, it's a bit laggy. But you can see that the countries in ASEAN have really benefited from this trade war that's going on between these two countries, right? So Cambodia up on top there, 200% increase in trade over the 4 years. Vietnam, 160%. Thailand and Indonesia around 60 to 80%. And so, that's the direction, right? That's the velocity. And then the bubbles that you see on the left-hand side of that chart tell you also a very important part of that story, right? Which is, of course, Cambodia, while it's increased, its share of US imports is very, very small. I think the big one there, of course, is Vietnam at about 4%. And if you look at the bottom of that chart, China is still 17% of imports, right? So there is some sort of cognitive dissonance between the diplomatic rhetoric, which has sort of ratcheted up the political rhetoric between the US and China, and the actual flow and volume of trade, right? Last year was the biggest year ever for trade between the US and China, right? So I think there's a need to sort of separate some of the rhetoric from the actual trade flows. And I think the important point here for ASEAN is that countries in ASEAN have really benefited a lot from this unraveling of Sino-American trade. But there are limits, right? We are in a region where trade and FDI, as I've just mentioned, are on the up. What I have here is a lot of different colors on a block. It's kind of a traffic light system. This is our business environment ranking. So you can see all the countries on your left, and then the different facets or drivers of that business environment ranking, from political effectiveness to the labor market to infrastructure for countries in Asia. And to draw your attention to that infrastructure column, and you can see there that if there's one thing that is sort of limiting some of the FDI that's coming in, it's probably to Southeast Asia is probably infrastructure. And you can see even countries like Vietnam and Indonesia and the Philippines sort of scoring very low on that. Vietnam over the last few years has been a huge source of FDI, but infrastructure is a bit of a limiting factor in Vietnam. Only 20% of roads in Vietnam are paved. That's a pretty low figure. If you compare the rates of secondary roads to highways in Vietnam, that's about 1 to 1. In most sort of developed economies, there are twice as many secondary roads that there are to highways. So, infrastructure plans are afoot in Vietnam. There's a fair amount of planning going, some investments, but that will take some time to benefit. So one of the blocks that we are seeing, of course, is in the infrastructure category for Vietnam and for Southeast Asia in general. So now I'll go through some of the trends to watch out for. I'll talk about politics, I'll talk about the green transition and peak plastics. Can't really not talk about ChatGPT anymore at any sort of forum, so I'll talk about that, and I'll give you a little quiz, and then look at the top 10 biggest risks that we are talking about in terms of the EIU. What are the risks to our forecast? So this year is kind of a political risk-off year. There are not many big elections. Of course, last year, there were the midterms in the US, and there were the Chinese, the Congress as well. This year, two probably to call out. One in Thailand. I was speaking to Anand before, and he called out this slide because we predicted the Thai election wrongly. And what this map here shows, we have three sort of barometers. The one in blue is our confidence in our forecast, right? So we were fairly confident that we would get the Thai election correct. That green one is what the results of the election would mean for domestic policy, and that purple one is what that election would mean for international policy, right? So in Thailand, before the election, we had forecasted that the opposition would win or gain quite a lot of seats. I think that was generally the consensus. We did think that there was some change in domestic policy. That's not surprising. And we did think that there would be very little effect on international policy. But it's still in flux in Thailand with the Move Forward Party, but what they have come up with in terms of their economic policy is quite different from what the other parties have put out there. The best description that I got from a client is that they seem to be the Bernie Sanders of Southeast Asia in terms of their economic policy. And certainly in terms of their international policy as well, it seems like they are going to have a bit more focus on the Rohingya crisis, which, of course, their previous administration had very little interest in as well. The other election is in New Zealand. We have less forecast confidence there, but also we don't think that that's going to have very big effect on either their domestic policy or their international policy. But in general, for the region, not a lot of huge elections that will change our outlook. And so I think that's a risk-off year in terms of elections. Several challenges will prevent the energy transition. So the story here is that before COVID and certainly before the war in Ukraine, the green transition into renewables was going along at a pretty decent clip. So there's a lot of investment. We saw a lot of changes. Of course, when the war in Ukraine occurred and there were a lot of increases in commodity prices that were inputs into the green transition and renewables during COVID, that took a hit, right? So it slowed down. In Europe, around the middle of last year, countries just had to get energy wherever they could, whatever color it was, because that was their imperative. And that sort of put the brakes on the green transition. But what we are also seeing now when we talk to clients and we talk to some of our multilateral agencies that we are in discussion with is that a lot of people also now recognize that there's a huge geopolitical discount on renewable energy. Right? You don't have to rely on an autocratic regime for your energy, and that we think is going to be a big driver to push the energy transition in the medium and the long term. So we expect it to pick up a bit and pick up quite quickly over sort of the next 2 or 3 years as commodity prices come down and people realize this geopolitical discount. But by and large, renewable energy, of course, there are exceptions, are not transported across borders. Maybe ASEAN is going to be a bit different in terms of that regard, but there's certainly that geopolitical discount to think about. Here I have 2 slides on peak plastics, and this is not on too many people's radar, but the UN is coming up with their version of what they want to do about plastics, and they're going to do that at sort of the end of the year, right? October, November. And so what we did is we took 3 of the things that the UN were considering: a ban on problematic, unnecessary single-use plastics, SUPs, a mandatory extended producer responsibility, so putting the responsibility on producers to reduce plastic use, and also a tax on the production of virgin resin. So we modeled these 3 different impacts, and essentially what we saw is even if these all 3 came together, it wouldn't be enough to sort of reduce plastic consumption to the level that is needed. But given all of these happening, there are going to be effects, right, on different types of companies. Of course, FMCG companies are probably really looking at this because any of these types of mechanisms might be used and it will have a big effect on them. But this is certainly something to watch out for with the UN. It will take a few years for this to come into fruition because the regulations will come out this year. There'll be treaties that countries will need to sign up for, targets that they'll need to set for themselves as well. But it's certainly something in terms of a trend that we should be watching in the medium term. And so ChatGPT, right? Let me give you a quiz. So we'll pause here and I'll give you I have 2 slides. So I have this slide, and I have this slide, if I can go back. And so I'll ask you now, take 10 seconds or 20 seconds and just read this slide. And my question that I'm going to ask after this is which slide did ChatGPT write? So I assume you've all sped through this slide. So now look at this slide and take a quick read of it. Lots of nice bullet points, a bit chunkier text. And so now show of hands in the audience, right? Put up your hand if you think ChatGPT wrote this slide. Anybody? I see none. I'll take that as a very unanimous decision. What about this slide? So many more hands here. I think everybody is convinced that ChatGPT wrote this slide. Of course, it's a trick question. ChatGPT wrote both the slides. What I did was, I use a different version of a generative AI model, not ChatGPT, but I put up ChatGPT because it's in everybody's minds. But I fed it previous slides that I've used, and it came up with this one. And then I fed it a different prompt, a solo prompt, and it came up with this one, right? So just a note to say that it's very difficult to figure out what is being generated by AI in terms of content. So, what does it mean for artificial intelligence taking off, right? Since ChatGPT came into public imagination sort of in November, December last year, everybody's talking about it. Suddenly, all the executives in Silicon Valley can't stop talking about it. There's been capital that has been driven into that sector that we haven't seen, especially given the tech slowdown. But we have to ask what it means, right? I've read a report from Goldman Sachs that says that it could increase global GDP by about 7%, or $7 trillion over the next 10 years. I've read an academic report by labor economists that says that it will increase labor productivity by around 3%. And of course, the agglomerative effect of that could be quite substantial. I've also, on the other hand, looking at the stock markets, not a lot of generative AI stocks have performed better than other stocks, not including sort of maybe the last 2 or 3 months, but generally that's the case. And then interest rates, right, which I think you can also ask some of the other economists that are coming up here. If we truly believe that generative AI and artificial intelligence would make us all not have jobs and still be very rich, then we would see long-term interest rates really going up, but we are not seeing that as well. So, how do we sort of conceptualize this, right? What is the effect of artificial intelligence going to be? I think it's very difficult to stand here and tell you what it's going to look like, but we have some kind of formative view now, and what we did is we looked at history, we looked at previous sort of big global industrial changes, and of course we focused on the Industrial Revolution. A lot of people thought that during the Industrial Revolution, the spinning jenny and the invention of the spinning jenny really sort of sparked that Industrial Revolution. But in actual fact, it was the agglomeration of many different factors, right? So it was workers' rights, it was better regulation, it was coal, it was different types of energy use. All of those came together, and the world really, really changed. And so one point to take away from that is that artificial intelligence is just one component, and we certainly don't know how that will have a huge effect on the global economy if it's just one, right? So you have to see what other components come in and sort of have an agglomerative effect with artificial intelligence. So that's kind of our view on AI. The other thing that we think might slow down the adoption of AI is regulations, right? So it's still a very greenfield environment. We've seen in Italy where they banned ChatGPT for a while and then pulled back that ban. Generally, the regulatory environment is very far off where it needs to be in terms of how we process and how we think about and what the legal implications of this very broad concept of generative AI can be. So we do think that the regulatory environment will slow down the adoption of a lot of AI. Certainly in some sectors, I think in healthcare, possibly because of privacy concerns. In education is another one because of how protected that industry is, right? So the regulatory changes might come on much slower, and that might pull back the adoption of AI in some cases. So here are our top 10 risks for the global economy, and usually on this slide we have a number of upside risks and a number of downside risks, but as I mentioned in the first instance, we are in a relatively resilient economy, but not something to shout about. So most of these risks are downside risks. And so I'll talk about a couple of them. One is that, we talked about that inflation and inflation being sticky. We do think it's coming down, but we do have an upside risk of higher inflation. That could be because of what we are seeing now. We don't know what the patterns are, and so maybe inflation hasn't really been tamed by all these higher interest rates, so we still have to monitor that. But of course, the other one that we are looking at that is especially important for this region and probably some regions in MENA is El Nino, right? So El Nino, now the National Oceanic and Atmospheric Agency in the States has said that there's a 90% of El Nino taking effect this year in the winter in North America, and there's a 50% chance that El Nino will be severe. And so that could drive up prices of foods and different commodities in Southeast Asia. We've seen that effect, I think the last time was in 2014 or 2015. Generally, countries like Vietnam, which were quite badly affected the last time, now have better stocks. They have better rice stocks, they have better buffers of other agricultural commodities. So we do think that the risk is low, but it's certainly something to watch out for. The other one that we always get questions on are conflict erupts between China and Taiwan. And you can see why, with spy balloons flying over different countries and politicians visiting Taiwan and things like that. That really ratchets up the rhetoric. It makes it a lot more tense. And both countries react generally by troops, right? By having more naval exercises, by having more army exercises. And what we think is that, we don't think that there'll be a deliberate conflict, but there might be an accidental incident, right, in the Straits of Taiwan. Something happening where it hits a ship or something like that, and that might stop trade for a month or a few weeks. And that could have an effect on the economies in Southeast Asia. So these are some of our risks. Most of them are to the downside. And so this is where I stop and I ask you to channel your inner taxi driver. I know I'm supposed to get a tablet with some of the questions that you've sent in, and we can take some questions before we invite up the other speakers as well. So give me a second to read these. It doesn't seem that we've got too many questions here. Do you think a global recession is necessarily really to tame inflation? So, we do think that what's going to happen is that a recession of some sort, or a soft landing, or maybe a near no landing in America and the US will tame inflation. That's certainly what we think is the signal that the Fed is sending. Of course, they won't come outright and say that. It will be helpful, but when you look at the job market and how healthy it is and how it's growing in the US, we do certainly think that a recession could be needed for inflation to truly be tamed, right? I think also inflation data is very tricky in terms of how it comes out, the pacing, and its effect, and so it's difficult to see in the short term exactly what you need. But I think fairly good sort of signaling by the Fed, which promotes more confidence, and of course a lot of the central banks in Southeast Asia look to what the Fed is doing for their own interest rates, right? So I think that's A good question, do you think a global recession is really necessary to tame inflation? What are the reasons behind the prediction that the Ukraine war will last another 5 years? Now, of course, I think predicting war is very difficult, so I could be made a fool in a couple of months. But generally, we see a couple of reasons, right? One is that there's some precedent, right? So if you look at what happened in Ukraine in 2014, 2015, we do think that that is going to be a similar outcome, except of course writ large over a broader swath of territory. Also, we just don't see a diplomatic solution, right? Putin and Zelensky are just not able to come to the table to take back anything to their respective countries that will be palatable. So we don't see a diplomatic solution either. And then we also did this interesting exercise that we call super forecasting, where we worked with a forecasting unit that has slightly different methodology to ours, called Good Judgment. And we asked them the question about whether Putin would be replaced by sort of an internal coup, right? That could also change the outcome of the war. And there was only a 9% chance. These super forecasters got together and they came up with a 9% chance of that happening. Now, in many other countries, we might think that that's a very high percentage. Of course, in Russia, that's a pretty low percentage as well. So we just don't think that that's going to happen. So those are three reasons that we think that the war in Ukraine will last another 5 years. Do you think that inflation was real, or is it only because of the war? And what does that mean for monetary policy measures? Now, I guess the inflation story globally is that there was probably a moment coming out of COVID where the Fed especially thought that inflation was transitory. There was a lot of money that was put in people's pockets, and they thought that as that dried up, perhaps inflation would come down. And they stuck to that for perhaps a while longer than they really should have, and then were a bit late to sort of increase the rates, right? So the war, of course, then came in as well and made things a lot more complicated in terms of certain commodities, in terms of supply chains, and of course in terms of global investor confidence in economies, right? So I don't think that the question was, is it only because of the war? The answer is no. I think that it was that reaction coming out of COVID and all of the subsidies that were put in people's pockets. That certainly had a big effect as well. And so because there are these two sort of countervailing factors that are driving up inflation, and now there's a lot of perception that goes into it. How high do you think inflation will go? All of that makes it a lot more difficult to kind of get a handle on inflation. The other thing, of course, that happened in the States in sort of March, April was the mini banking crisis that they had there. I think we were quite sheltered here. But that also makes the job of the Fed much more difficult, right? They're trying to increase stability in the banking system while at the same time trying to tame inflation, really moving in two directions. That makes it a very difficult job for them. And I see a lot of questions now on Southeast Asia as well, so it's probably a good moment to start inviting up some members of the panel. But let me take one or two questions here before we do that. What about reducing corruption in ASEAN to improve investments? Well, let's talk about a couple of countries, right? So let's talk about Vietnam. In Vietnam, there have been some grand gestures to reduce corruption. I don't think those measures extend to sort of all levels of the economy. So we think that corruption will still be there in Vietnam. That makes the business environment, of course, more difficult. But in a funny way, in Vietnam, that also sort of contributes to stability, right? If there was really sort of a huge effort to reduce corruption in Vietnam, that could have some effect on political stability. So we do think, for example, in Vietnam, while these grand gestures are there, and there are certain sort of high-level officials that have been sacked or brought down because of their involvements in corrupt practices. We don't think that the general corruption environment will go down. And we of course have some representatives from Maybank, so we can ask them that question again. But Indonesia is another interesting case, right? As we go into the election season there, what we think internally at the EIU is that does provide a lot more room also for corruption, right? And so we can see perhaps during that period over the campaigning, which lasts a decent time, that corruption will increase there as well. So, of course, reducing corruption will improve the business environments, but there are several reasons that we think it's a very difficult thing to do, right? And I mentioned Vietnam, where there's this tension between really wholesale changes and political stability. Why is the job market so strong despite so many job cuts by tech companies and some banks? Now, I think tech companies, and I worked for one of them during COVID. A lot of them just hired very, very aggressively during the COVID period, right? They thought a lot of that behavior, with everyone being at home and everyone being online, would continue. That behavior would be sticky, and I think that it wasn't as sticky as they thought. A very interesting figure that I saw was that after the first round of all of the tech companies cutting the jobs, and there were quite massive layoffs, and they were not always done in a very organized manner, which doesn't promote a lot of confidence. Most of those companies were still bigger than they were a year ago, right? So that puts some perspective on how big they've grown and how fast they've grown and what the sizes of those companies were. So I think that they've sort of had their dose of reality and have cut down now, especially in this high interest rate environment, what it means for investment and putting around capital. And so it's probably a necessary shift that we would have seen elsewhere. I don't think it is too indicative of what's going on more broadly in the economy. It's more focused on those particular sectors. All right, so we have a lot more questions on Ukraine, which we can ask later, but we also have a lot of questions on ASEAN. And so I think it's a good time to seg and invite the heads of research for Maybank up onto the stage. And if I could just get the slide with all of their names up. Oh, it's at the back. Yes, so we have, hang on, it was at the back. More for myself. Yes, so we have Anand Padmakandan, Head of Research for Maybank Investments Malaysia, Thilan Wickramasinghe, Head of Research for Maybank Securities Singapore, Quan Trong Tan, Head of Research for Maybank Investment Bank Vietnam, and Jeff Chen Lim, Head of Research for Maybank Securities Indonesia. And what we're going to do is they're going to do a quick deep dive into each of their economies, and then we'll take questions once they are all done. I think Anand will start with you.
Yep. Hey, thanks, Sumana. So so we'll be taking a couple of minutes each to give you some top-down views or highlights of each country. And being the last session of this conference, we're all prepared to be very candid and direct in what we need to say. So please, do send in your questions. I think looking at the sequencing here, I think my colleagues will agree we're going with age before beauty first. And we're also going to go with the most challenging market first, which is Malaysia. And we're going to work our way up to the the belle of the ball, which is Indonesia. I only say that half in jest, because Malaysia has been a very difficult market for many investors. Yeah. So we've had this conference for 10 years now. 10 years ago, the KLCI benchmark index was 20% higher than where it is now, and market volumes traded were substantially higher as well. So the market has gone through a lot of challenges. And I have a few talking points here, but I'm not going to go through that in detail. Instead, I'm just going to go through my wish list for the next 12 months. But I have to start with history first. When did it all start going wrong? And I think in my view, for Malaysia, it all started going wrong when we had 1MDB. Yeah, that huge scandal. And that led to the downfall of the coalition government that has led Malaysia since independence. So it injected something into the Malaysian market that investors were not used to, which is political instability. And it's always been a big thing we're very proud of in Malaysia, that like Singapore, we're very stable, the market deserves a premium for that stability. We can't say that anymore. In the last 5 years, we've had 5 prime ministers. Yeah, so that's not political stability. In some parts of the world, that may be business as usual. Yeah, but in Malaysia, it's definitely not. So it's taken both the population, the people, as well as investors time to get used to that. So where are we now? So we had general elections last year in November. The outcome was fairly favorable for the market. I think the ruling coalition, Prime Minister Anwar, more pro-reform, liberal-leaning, which I think is what Malaysia needs to move forward. But it feels like the politicking has not ended with general elections. Yeah, we're 6 months into the administration, and it feels like our Prime Minister is still on the campaign trail, rather than passing policy. And there's a good reason for that. I don't really blame him, because the opposition is quite powerful. And we do have state elections coming up in Malaysia. And if you talk to any funds who are looking at Malaysia now, nobody's doing anything. Everyone's on the sidelines, because these state elections, which are going to be held maybe late next month, late July or early August, quite an important sort of vote of confidence in the government. And it involves 2 of the most prosperous states in Malaysia, Selangor and Penang. And there are 4 other states, but these are the 2 that everyone is watching. So there's a lot of concern. There could be a change in government, maybe in Selangor, and that could derail the entire policy agenda of the national government. So even though we may not see a change in government because of the election results or the state election results, it could still derail a lot of our expectations. And I won't give you the bad case expectation, because the way Malaysia is traded, we're already in bad case. So I think I'll give you what investors want to see in the next 12 months. So first, obviously, state elections, we want the status quo to be maintained. We don't want to see any disruptions in state control, especially for Selangor and Penang, that could derail the ruling coalition and bring up talks of a collapse in government again, because we've been through that so many times, and it's never a good outcome. But beyond that, there's a lot of work to be done. Malaysia, firmly middle-income trap country. You can see that from slowing earnings growth, very high debt levels, and lack of policy momentum to deal with these issues. So I think we need to see 2 things. We need to see a lot of fiscal reforms, which the government has not pushed through yet, because it can be quite unpopular with voters. So we have a plan, an announced plan, to bring the fiscal deficit down from 6% plus for the last few years to 3.5% by 2025. So that's almost a halving in the budget deficit. So that's a tall order. And it can't be done without higher taxes and lower subsidies, both. Not just one or the other, but both. And these are obviously very sensitive questions. So we really need to get past the state elections and be able to push through those reforms. And we hope when we have Budget 2024 announced in October, we'll see a better timeline and more sort of clarity on how the government plans to raise taxes. And the most obvious tax is GST or VAT to some of you. And obviously to also cut costs by bringing down the subsidies. And we have very generous subsidies in Malaysia, especially for petrol. Petrol is cheaper than water in Malaysia. As you Singaporeans all well know, because you guys all drive over on the weekends and fill up. So, we have to deal with that leakage as well. And then beyond that, we have to do more market-friendly measures. I think that's the second step for the government, because you can tell from our capital market, things are very illiquid and there's a lack of confidence. So I think that really requires reforms at a more corporate level. So I think something that we've talked about a lot in Maybank research is GLC reform, a government-linked corporate reform. These are companies which are a big part of the index and the market. But when you compare their performance to their private sector counterparts, in whatever sectors you're talking about, banks, telcos, utilities, plantations, properties, healthcare, their profitability is well below their private sector counterparts. And that's a big drag on investor interest in Malaysia. If we can fix that, then I think we're back to the races for Malaysia, because Malaysia does have a lot of potential. We just need to put the building blocks in place to realize it. So on that positive note, I shall pass it on to Thilan.
Thanks, Anand. My two colleagues to my left have far more exciting stories to tell, but when I talk about Singapore, it may not excite investors a lot, but it has been very, very resilient through COVID, through the Ukraine crisis, through this year. It has actually been one of the better performing markets in Southeast Asia, maybe except for Vietnam. And largely, this is driven by the defensiveness of the mix of the market. You've got a very heavy representation of value stocks, banks, industrials that are generating real profits with a much more stronger visibility in terms of earnings than what has been the flavor for the last sort of decade, which has been a lot more growth oriented. And also, I think one of the least appreciated facts about this market has been the fact that it has been relatively inflation shelter. Now, this may sound counterintuitive when you look at condo prices and car prices and everything else, but if you actually drill down to at the corporate level, a lot of companies have actually been able to pass through, at least partially, some of those input cost increases as well as some of the interest rate increases downstream. So that has actually enabled them to manage margins a lot better. And also balance sheets are a lot more liquid. Gearing in for all the listed stocks in Singapore, about 43% of them are net cash. So in fact, interest rates actually rising hasn't actually had the negative impact that most people expected. So I think you have this very resilient market, which is fairly reasonably priced as well. On the short term, I think one of the biggest sort of known unknowns that we are all kind of looking for is this, how quick China reopening can happen. I think that's one of the key catalysts, what we think will drive Singapore higher across most of the ASEAN markets. When you think about exports, when you think about tourism, when you think about investment, Singapore is actually one of the more geared markets across this region. So I think as China reopens and as you start to see that process take shape, you should start to see some near-term catalysts. But what really excites me, for a lot of investors, when I go and speak to them and they go, Singapore, but when I actually look at the market on a longer-term basis, I actually see 5 catalysts, which I think can structurally make a difference to how investors view this market. The first is safe haven flows. I think it has been proved very, very clearly that over the past few years, Singapore's policy framework, its capital framework, its regulatory framework has been quite strong in terms of providing a safe haven for a lot of investors. And I think that will continue to go as long as, as Sumana said, you might have another 5 years of Ukrainian war and all that sort of stuff happening. So I think safe haven flows will continue to be a positive driver for Singapore. The second is one of the things that has got me excited a lot, and that is GLC restructuring. A lot of the Temasek-linked companies in the past have really not done much, except particularly the last decade, nothing much has happened for a lot of these companies, except for the last sort of 2 to 3 years. You're starting to see a lot of these companies restructuring, looking to improve their ROICs, getting rid of divisions that are not really core to their business. We saw that with CapitaLand, we saw that with Keppel, we saw that with Sembcorp, and we actually start to see the market rewarding a lot of these stocks because of that. Keppel and Sembcorp, for instance, are some of the best performing stocks within Singapore. And I think you're going to see a lot more of that happening, particularly with names like Singtel and so on. And the third driver we see is supply chain relocations. And again, Sumana talked about how ASEAN is benefiting from the US-China trade war. But I think Singapore as a financial center and with a lot of the regional banks here and as a center of capital, I think you're going to see a lot more opportunities from that happening. And I think fourth is ESG investing. Now, for a lot of investors, you're seeing their mandates being structured towards, focused towards more and more ESG investing. And across the Southeast Asian markets, Singapore actually offers some of the more ESG-friendly stocks. And so there is a scarcity premium for a lot of these stocks as well. So again, I think that will drive interest in this market over the longer term. And then finally, I think the final factor I want to kind of highlight is regional M&A. As I said, a lot of these companies have very low gearing, they're flush with cash, and valuations regionally have also been not very exciting. So I think you're going to see a lot more transactions happening of Singaporean companies going overseas. We saw that with examples like UOB and DBS buying some of the Citibank's assets, but I think you're going to see much more broader transactions happening. So I think on an overall basis, for a market that people tend to consider boring, and that is something that I need to fight on a regular basis, I think there is significant amount of drivers within this market for investors to take a look seriously and get excited about. In terms of overall stock picks and things like that, I'm happy to take that during Q&A, but I think one of the key things that I want to kind of leave is our sector preferences. We're generally positive on sectors such as gaming, healthcare, industrials, services, and transport. We're a little bit neutral on banks and property, given where the interest rate cycle are, and we're negative on the tech manufacturers and plantations. And I'll stop there and hand it over to Tan.
Okay. Good afternoon, ladies and gentlemen and friends. So before coming on to this stage, I try to update on the return of the Vietnamese stock market. Right now, about like 10% year to date. So we kind of outperform ASEAN market. But if you ask me, I'm cheerful, excited about that. The answer is not really, because I see the return so far is mostly the local retail like excited about it. Why? When we talk to our clients, especially institutional clients, we haven't seen them coming back yet, actually. And yeah, they remain skeptical about the country. If using an analogy, like Vietnam is like a teenager, and we got drunk one last night, and now people are quite skeptical. Is this guy a bad boy or a good boy? So last year, the stock market, like after we enjoy a good rally during the COVID time, like reaching like 1,500 points, and we've gone through a turbulence, and it dropped like 45%. And the problem is that the last year when we see the change in the landscape, especially when we see the anti-corruption campaign accelerated. And it really created some breakdown in the confidence. And also it kicked us into the situation like we see the interest rate really surge. In just 1 month, it surged by about 200 bips for policy rate, but on the market, the deposit rate surged like 400 and 500 bips. So like we see the deposit rate about 12% at that time. And more seriously is that a lot of think tankers who they try to share their views and want to write the reports and share that views about like the problem with the economies is getting weak. But then the top leaders they didn't buy in that time. Luckily, we see that situation has changed a bit. By now, I can say all the top leaders, they were aware of the situation. They are aware of the situation. And that's why you see the change in the monetary policy of Vietnam. Vietnam central bank is the first one to cut the policy rate. And by now, we have 4 rounds of policy rate cuts. And that have regained some trust in the market. About like what Vietnam has been aware of, but I think the market will be supported by more policy rate cut in my view, because in our analysis and projection we need to see the lending rate to go down by around at least 100 bits more to support the economy. So we expect that in the next 3 months there could be at least 1 more round of policy rate cut, and this would support the economy. And in terms of stock market, we think there could be additional at least 7 or 10% more upside. But after that, we need to factor into account like the real economy, how it's going to recover. And I believe that most of the long-term investor here also concerned like, can Vietnam get out of this cycle? Are we in just a cyclical downturn, or are we in a structural downturn? So what I can say for now, and also I hope that if you or your colleagues have chance to meet the Vietnam corporates joining this conference, I hope that you get some good views about like what the economy is. What I can say now is Vietnam, with the timely and accelerated action from the government, we can avoid a structural downturn, the kind of like 2008 crisis, something like that. But we are in a cycle of downturn. That means it comes with the policy with the interest rate surging and with the economic slowdown. But now I can say that the interest rate is trending down, so it's good for the market. But the real economy, there's several factors in play now. We have the recession in the US, EU still there. So that's why it affects Vietnam. The export slowed down because Vietnam is a very open economy, 200% of export import over GDP. So that would affect the domestic consumption, which used to be a strength of Vietnam. But I think in the midterm, it's affected a bit because of the reverse effect from all the bond and property market turmoil. And that would last for, in my view, at least another 6 or 8 months. But on the other hand, we have some supportive factor. Is first, the government in attempt to improve Vietnam infrastructure, which is a bottleneck in the FDI story, as Sumana mentioned. So we this year set out $35 billion in the budget for infrastructure investment. So that is 75% higher than the actual investment last year. And that would be the first support factor for the economy to recover. And secondly, we expect the China recovery. By now, the China recovery still look a bit fragile to in our view. But then we factor that into our forecast, and we think Vietnam still can achieve about 4.5 to 5% GDP growth this year. So, and any better recovery from China would be very helpful for Vietnam. So that's the midterm story. What the key takeaway I want to emphasize here is Vietnam is just in a cyclical downturn, and it's mostly driven by the policy. So once the leaders, they're aware and they change the policy, I think we can see the recovery faster than the concerns. In the long run, I think that two catalysts, kind of structural for the market in my view is, first, Vietnam is now just one notch behind investment grade by S&P rating. So if we can come out of this turmoil and then we build a better regulatory framework, that the sovereign rating upgrade could be the first strong catalyst for the economy in terms of both FDI and FII. And the second catalyst is Vietnam market upgrade to emerging status. We are here, Vietnam is still in the frontier, and that's why it has been limited Vietnam's capacity to attract foreign capital. That's why you see the Vietnam stock market structure now is a bit imbalanced. We have over 85% of daily trading value is from retail. And that's because the retail, they have joined the market during the COVID time, and they have the interest and the knowledge about the market has increased a lot, and we keep seeing more money from retail coming in. So that's why it has Vietnam's daily trading value from $200 million per day. It surged to $1.5 billion in 2021. And then it dropped to around 400 million during the 2022. But now we see it coming back about 800 million. It's mostly from the retail money first. So we cannot, and of course the retail money will stay there. So now for the market structure to get rebalanced, we expect is the foreign institutional money to come in. And that's related to, we need Vietnam to be upgraded to emerging status. And we can have a more discussion about that during the later part, but then I would stop here. But that two catalysts would have us to be re-rated. We normally trade it at about 10 to 13 times. But if we upgrade, I think 16 or 18 times PE. That's structural upside for the investor. Thank you.
Thank you. Jeff, over to you.
Hi, good afternoon, everybody. Uh, I'm wrapping up the session for the lineup. Yep. For Indonesia, I'm quite bullish with the target index at 7,600, around 12 to 13% return for the year. If we see Indonesia is still growing right now, this year is around 5% and next year around 5.2%. So in terms of in the global slowdown context, Indonesia economic growth is quite attractive, especially for the global investors. In fact, this year to date, we have inflow to our equity is around $1 to $2 billion, and to our government bonds is around $4 billion. So we still having a positive inflow, and the performance for this year is around minus 2.5%, second highest among the ASEAN countries. I think in the second half we have a couple of important tailwinds. The first one is we will see a backloaded government spending for the second half, and it will boost consumption and the economy. And also we have this election coming up. We have the pre-election campaign spending. It's going to be a big election because it's not only on the presidential level, but it's also on the parliamentary level. This time, this is the biggest election so far for Indonesia. So we're going to get a boost from that one too. Also, we feel that last year, the commodity windfall tailwind, we haven't fully benefited, but I think we will feel the effect from the commodity tailwind from last year, especially on the property sector. And lastly, we all really hope for China's recovery. We hope at least on the Q4, we will see some recovery. Therefore, a revival of the commodity demand benefiting the country. Yeah, if you look at our trade balance, trade surplus on the bottom left, we have already experienced around 24 months of straight trade surpluses. So it's due to the commodity price increase, especially the coal, nickel, CPO, but as starting from last year around fourth quarter, the commodity price become declining, and that's why we hope for China's recovery to support the demand on the commodities. For our themes that we like this year, we like broad-based consumptions, and also we like broad-based this discretionary play, and we also like the blue chips banks, but we prefer to buy on weakness. Other than that, we also like poultries. Poultry will be benefited with the soft commodity declines. Yeah, so so the risk that I mentioned is the trade surplus narrowing down, and also the strengthening of USD. So far, if you look at our key reference rate is at 5.75, and the Fed fund rate at 5.25, which is quite close. Never before in history of Indonesia that the key rate is so close with US. It can become an opportunity and also can become a threat. Yeah. What I'm seeing is that we may reach the peak for rupiah at around 14,500, and I expect the rupiah could weaken because of the spread is so thin now, and also the trade surplus is narrowing down. That's why I recommend clients to rotate from companies that will have a headwinds from rupiah weakness, go to the shifting to the beneficiaries of USD strength. I stop here for the
Thanks,
Q&A.
Jeff. So that's great. We've got a lot of questions in, so I'll ask the panel to keep your answers short. What we'll do is we've got a couple of questions that are sort of ASEAN focused, so I'll shout out the questions and ask for a volunteer to pick it up, right? So the first one, I'll put two of them together. First one is, what is the suggested equity allocation across ASEAN for the next coming 12 months? And the other one is, can you share a bit on your outlook for the real estate sector in Southeast Asia? So I don't know whether any one of you want to pick up those two.
So I guess I have to take the first question since I'm regional head. I should have a view. Well, I can tell you, I mean, we don't have a formalized sort of breakdown as to how, or model portfolio as to how we want to be allocated across ASEAN. But I can tell you what clients are saying and where the interest is. Clearly, Indonesia appears to be the most favored market at this point. I think the whole EV supply chain, the underlying consumerism, consumer story, still very intact. And I think, unlike many elections in ASEAN, the upcoming election is not very controversial. It appears to be that the candidates are going to pursue the same policies as Jokowi has been pursuing. So nobody's unduly worried about Indonesian elections, unlike other parts of ASEAN. So I think there's a lot of continuity in Indonesia that investors like. The other two markets where we get a lot of interest, one is Vietnam. So a lot of clients are being tactical about it. And as Tan has mentioned, things are sort of righting themselves in terms of policy. Interest rates are coming off. And if we talk about thematics like supply chain relocation, Vietnam has been enjoying that for years, even before the most recent spike up in geopolitics. So I think longer term, even if we don't get those two catalysts that Tan mentioned very soon, you can still see quite a good runway for GDP growth. And the third market, final market, where investors are sort of interested to be weighted, actually Singapore. I think, as Dylan has mentioned, there's a lot of interesting stuff happening with Singapore corporates, a lot of restructurings. But also, I think the safe haven appeal of Singapore, in terms of the currency exposure as well, is a major draw for many investors who are still very uncertain about the future. And that's paid very high dividends. As a Malaysian, seeing the ringgit hit new record lows against the Sing dollar every day, I can only look on with envy at Singapore dollar investors. So I think those three markets is where we would be overweighted. I think the Philippines, still some issues in terms of very high interest rates and inflation. Malaysia, well, we always have issues. So I think you should wait until after the state elections are done, and then we can sort of refresh our view. And Thailand, I think we have to wait for the formation of the government, whoever or whatever form that may take in July. Yeah.
Thanks. Dylan.
Yeah, so, since this is a Singapore audience, I'm sure the main question asking is on Singapore real estate. I think in our overall view is that the overall volume side will start to see some dip, given the fact that you've got multiple cooling measures that the government has put in, but we are not really expecting to see a major weakness in terms of overall pricing. I think the fact that you still continue to see safe haven flows coming into Singapore, that'll provide some support, while everyone kind of talks about how mortgage rates have increased. Mortgage rates have increased, but it's still around 4%, 4.5%, which is still significantly a lot lower than some of the other regional markets in the first place. So I think while the government is looking to bring in more volume and so on, so that'll provide some support. I think the fact that you have this safe haven flows, you've got the mass market, the HDB resale market also having had a significant run. There's a significant amount of equity that has been built that can support the private side as well. I guess the other ASEAN market where there would be some interest is Vietnam. So I'll let Tan.
Yeah, sorry. Well, yes, so property market has been at the center of the turmoil since last year, but the problem has going back to like 2018. So we see that the anti-corruption campaign is focused on this segment the most, and given the views and given the policy change, I think the profitability profile of property sector in Vietnam would be kind of not as robust as before. That's for the stock market view. Before, like, because the land buying acquisition cost is not so high, so property developers in Vietnam enjoy the gross margin of like 50%. Like the largest developer like Vinhome, they enjoy that. But I think given the change in terms of policy, like they just take the kind of try to find a market-based mechanism for the defining the land price. So that would make the cost higher, so the gross margin would definitely be lower. So I think in terms of stock equity investment, it would be very selective. We can only, in Vietnam now, the largest developer now, the top 3 largest, each of them has a specific problems. The second, like Novaland, like Evergrande in China, is already not the case anymore. The largest one, the best one, is Vinhome, which is traded at very low level valuation, below discount to its real net asset value, but then it's linked to the bigger group, make the interest, make the kind of risk in terms of internal party transaction make it not very like a keen buy investor anymore. But then if you go down to kind of more like mid-sized property developer, I think there's some good chance, because you see the demand in Vietnam for housing is still huge. So if you read in the media, people say, okay, the price of house in Vietnam is much higher than the income. But if you break it down in terms of segment, the affluent people in Vietnam, they can afford that kind of price, and the supply is still way below the demand. The middle income, the same story. Like we see in last year during the turmoil, but a South Korean developer, they opened a project, and the price at least $8,000 plus per square meter, they still sold out. So the demand for is very strong like that. So I think if you invest directly in property, yeah, it's time to come examine. There's still a lot of upside there. So in terms of stock market, very selective, because the profitability profile is much different now. Yeah.
Excellent. Thanks, Jeff. This question is for you. We talked a lot, you mentioned it, about the EV supply chain. Can Indonesia truly develop an EV ecosystem? What are the challenges?
Sure, yeah. What Indonesia have is beside copper, yeah, we have nickel. So nickel is needed for the EV battery. The challenges is that right now we can build the ecosystem. It's just that the EV battery based on the nickel technology is only for the premium and also for the big trucks. Yeah. It's not that suitable to Indonesian needs in terms of the motorcycles and also the passengers cars. That could be a hurdle for these ecosystems downstreaming. But if there's a initiative from the government to expand the nickel battery technology to be more applicable to the 2 wheels or 4 wheels, then we can create a bigger market for Indonesia. Because right now the battery technology is based on the lithium, which is we do not have any lithium in Indonesia. So that could be the shortcoming. And also for the EV downstreaming, we need a lot of capital, big capex. And right now the big investors that we see is only from China, but the Korean companies is coming in, also the Japanese. But majority are still Chinese based. So that's why our challenge is that how can we be included into the US ecosystem, the Inflation Reduction Act that cannot be, we cannot sell our supplies if it is not included in the FTA, the free trade agreement. So Indonesia is still not yet into the list that can sell EV batteries products to US as of now, but they are still in negotiation. Those
Thanks.
are the shortcomings.
Yeah, so certain fundamentals there, but of course, as you mentioned, getting into Inflation Reduction Act and FTAs, those will really change the game. We have time for one more question, and I think that goes to Vietnam, so to you, Tan. It's about policy trends over the medium term in Vietnam, about restructuring SOEs, incentivizing more FDI in different sectors. What do you think of government regulation there in terms of those two factors?
On the FDI first, then I think the leadership in Vietnam, regardless of the change in the prime minister, FDI attraction is always the priority, and especially from 2021 when the new PM, which is the current PM, he really pushed for that. And the way that I read his speech, his statement, he wants to leave a legacy that he's the one who level up Vietnam in terms of FDI, because if we recall in recent time of Vietnam, we have 3 PM, and the first one, he's the one who promote SOEs, and the one that before this one, he want to promote the SME sector, the private sector, and that's why we see the booming in private sector company like Masan, like Mobile World, like Vingroup. And now the current one, he want to leave his legacy as a FDI promoter. So we have been trying to build up the policy to attract it, and some indicator you can see, like last year, with the volatility of the FX, instead of let the FX just move along with the regional, but Vietnam government will use the interest rate. We okay to let the interest rate go up to defend our FX, to keep it stable, so that it would not affect the FDIs. That's an example. And now when we see that we want to build out the infrastructure, that's to attract higher, better FDI. It's not just FDI in textile or footwear segment anymore. It must for the high technology FDIs. And we see last year Lego, it opened the 6th factory in Vietnam, and it's first carbon neutral factory. That's because Vietnam has prepared, and we have ramped up the renewable energy and built up and have an industrial park for that. So that's all to show that the government really focus on FDI attraction, and the plan to invest in infrastructure is a real deal, because we are aware that the logistic cost of Vietnam is high. There's some statistics say that is about 20% of GDP compared to just 9 or 11% in Malaysia and Singapore. We need to halve it, so that's when we need to build out the infrastructure. On the SOE, Vietnam's economy has been started as a very command economy, so that's why you see a lot of SOEs still exist. We have been trying to push for privatization of SOEs, but then, from 2018, that's totally come to deadlock, and that's because of the politics development thing. And honestly, by now, there's no clear plan like how they reignite that, because the agenda so far is not. I haven't seen that put on high agenda, but I think definitely we need to accelerate public spending for infrastructure. But where's the money? They can continue to raise more from bonds, but I think there's a cap. There's some curiosity that why Vietnam's public debt to GDP is just 43% compared to the threshold of 60%. Why you cannot raise more bonds for investment? But actually, if we look into the ratio of the debt financing over the total state budget, is capped at 25%, and we are now at 22% already. So that means they cannot continue to rely on debt. So they must, I think they would come to the point that they need to sell some assets. Excellent. So that's the push for privatization of SOEs. If I need to put an expectation, I think only maybe after 2024, when all the kind of political things are settled and all the things in terms of saving economies settled, and then they would put that back. Yeah.
Thanks. Thanks very much for that answer. So very quickly, to summarize, Anand, a bit downbeat on Malaysia, but things to watch are the midterm elections there, and certainly what will happen with the budgets later after that. With Thailand, in Singapore, in this amoral economy, still continuing to attract a lot of FDI, so we do see some positive news there. Of course, in Vietnam, problems with or challenges with the property market, but a lot of levers, as you just mentioned, that the government can pull to increase FDI and to privatize SOEs, so we can expect that. And Jeff, EV is very exciting in Indonesia, and as we come into the election season, of course, you do expect a sort of policy continuity, which is good for investments. And with that, please join me in thanking our heads of research for Maybank Investment.